Hello traders and welcome back to another video here on the Learn to Trade channel. And today we are going to talk about the US dollar because it's non-farm payroll Friday. But before we go any further, if you want to get my signals, you should click the link below this video. And it only costs £50 for 30 days worth of swing trading signals. Now, without further ado, let's start this video. Start with the US dollar, right? Tomorrow is non-farm payrolls. I have not seen the numbers just yet, but why don't we take a look together, right? We have Canadian employment numbers and US employment numbers, right? You already know that for me, the most important numbers are the average hourly earnings and the unemployment rate, right? Why? Because, I mean, it really doesn't matter if more jobs are created and the average hourly earnings keeps decreasing because even with higher jobs or more jobs created, people are not going to have enough money to consume, right, or to buy products or services. Thus, the economic wheel would not be oiled. Let's call it like that, right? So let's have a look at the average hourly earnings on the past few on the past few releases all over the place, right? 0.3 to 0.2% increase. I mean, it has stuck on the same 0.3, 0.2% increase for a while now. If it goes negative, that is where the problem is, right? So right now we are expecting a zero point 0.2 increase. That's um, lesser increase than it was last month, right? And let's see the unemployment rate. It's expected to increase by 0.1%. So that is another problem that I see with this. But check out this. Non-farm employment change is expected to be. Let's just have a look at the past few months, right? The non-farm employment change is expected to be only 60,000 jobs created in the past month versus 245,000 the previous month. I mean, these are just bad numbers or bad employment numbers as I see it in the United States, right? Again, we are not going to front run this release, but we are going to look for opportunities to sell the US dollar if these numbers hold, or even if they came out, or even if they come out worse than expected, right? So what we're going to do is we are going to first of all look at the US dollar or the DXY. The DXY is the US dollar currency index, right? You already know that the US dollar has been in a massive down move for a while. This is the daily chart on the US dollar, and from high to low, we are in a minus 13.5% move, or 13,000 pips to the downside, right? Yes, the US dollar is currently very bearish. Why? Because, well, you already know what's happening in the United States, the instability of the government, and of course, we have to look also at the liquidity injection that has been provided by the Federal Reserve, which its portfolio or balance sheet, I'm sorry, balance sheet, not portfolio, is at all-time highs, right? So there's the biggest round of quantitative easing that we have seen that has pushed price down, right? And we are looking for further downside. Now, if we look for the 2 hour chart, I'm sorry, the 2 day chart is the 2 day chart, the 3 day chart I want to look at. Um, Really, the levels that would interest me um, for a possible bounce, right? Remember, we are fundamentally bearish on the US dollar, and as you can see, every time we have a small move to the upside, it's just a consolidation before the next move to the downside, right? Bulls are getting slaughtered in this market, and I mean, I don't know anybody that is holding US dollar in a cash portfolio, right? But the level that interests me is the 88.40 level, which are these lows. These are the February 2018 lows, and this would be a massive, massive base, or is a massive base on the US dollar, right? This is the break it or break it level on the USD, in my opinion, because if price breaks to the downside, right, there is really, really, really not much room, or there is really not a level that will hold sellers from selling off this market until the 84.30, which would mean that we would be looking at a massive 6.5, 6.4% move to the downside, right? So the second line that I draw is the February '09 highs and also the May '10 highs. This is the level that we are currently trading in, and we are currently rejecting, I'm sorry, on the 3-day chart. Let's go to the 2-hour chart, and as you can see, it's all over the place, right? So let's stick with the daily on the bottom right of our chart, of our screen, like we always do, and let's go ahead and let's have a look at uh, the hourly, right? Remember that because this is the DXY, we don't have any volume uh, at on the top right chart on our screens, but that doesn't matter, right? Well, the level that we all been looking at is the 90, the 90 level that we just retested and rejected. So this candle formation is quite bearish, in my opinion, in the sense that bulls try to push price up, retested the 90.10, but immediately were slammed down by bears, right? I'm not telling you that this is a sell signal. I do not do signals on the DXY. So this looks like a reversal pattern on the DXY around the 90. In my opinion, we are going to look at a bearish continuation only and only if we break with these lows around the 89.80. So the 89.80, and take note of everything that I'm saying, is the make it or break it level short term. Let's call it like that, right? Short term, the 89.78 to 89.80 is the level that we are going to be looking at for holds or flushes on the DXY. Remember, non-farm payrolls is quite a volatile day, but I mean, on the past releases, it hasn't been quite volatile, like 2 years ago, let's say. But I mean, we can expect anything. Remember that we don't front run these releases. Why? Because um, it would be crazy for us to front run and sell the US dollar hours before the non-farm payrolls releases, because we don't know if we are going to get 60,000 jobs created last month. It could actually be 500,000, and if it's 500,000, the US dollar is going to rally, right? So we are not going to do that, but we are going to closely monitor the 89.78 level for the DXY. Now, having said that, why don't we have a look at the GBP, at the euro US dollar, right? So I'm going to add the euro US dollar here to the daily watch list. Yep. And we are going to have a look at it, right? The euro versus the US dollar has been moving down from the highs. And the thing about the euro versus the US dollar, if you look at the daily chart right here, it has been quite choppy. This move to the down to the upside has been quite choppy. And personally speaking, I have been looking for opportunities to sell this because it really looks overextended on a massive, massive bearish divergence on the daily. Remember, these are only technical levels, but this channel or this structure is still holding in the sense that we are still making higher highs and higher lows on the daily, which means that we are bullish on the daily. Higher lows, higher highs, higher low, higher high, higher lows. Now, should we break with some of these lows, we could be looking at shorts on the euro US dollar, but for the time being, we remain um, bullish short term and mid term, right? Let's have a look at some levels on the higher time frame, the 2-day chart, the 3-day chart, etc. Remember that, well, we are above these lows, right? We always look for the in an uptrend, we always look for the previous lows, right, or the previous base. That is what is going to be holding this market down. But we actually broke with this level, and now we should be looking at this one right here. So in on the 2-day chart, um, on the 2-day chart, this looks it looks like a reversal pattern is forming at the top of the chart, right? Now, after we broke to the upside, when we broke with this continuation structure, right? This was a great trade. We have hit the 123, right? This 123 level, let's have a look and let's calculate some targets to the upside. It's right here. We have hit the 161.8 on the daily chart. These are short term. Well, in this case, these are midterm bullish targets, and we could be looking at a reversal. Now we're going to go to the daily chart to the previous highs, right? This could be interesting, but because we are looking at a possible dip in the US dollar, a dip in the US dollar would be and is bullish for the Euro USD. But in any case, this is something that should be considered. I am not going to short this market anytime soon, but as you can see, the divergence is massive and has been printing since late July 2020. Remember that a market can stay divergent for a long time before the actual move. So be careful with those divergence plays. Um, you need to you need these levels to break, right? Now this is the Euro USD on the daily. Now, if we're looking at today's price action, let's have a look, right? At some levels. Let's go to the 2-hour chart to get some noise out of the market. And the level that we're going to be looking is this one right here, the 122.20. The 122.20 is the level that we are currently rejecting, and we rejected the past couple of sessions ago, right? This is also a level that held as resistance, then it was retested, and is being retested right now. Now, this is again not an idea to buy the Euro USD. We have non-farm payrolls pending, and again, buying the Euro versus the US dollar right now and putting a stop loss right here is just burning money. So we're not going to do that, right? But this is the level that we need to be looking for. And if we actually have some very bad non-farm payroll, very bad employment numbers out of the U.S., I reckon that we could actually be looking for a stop hunt to the 120 2160, which means that we could be looking at a play to the 121.60 for big longs to get into the market. So these are the two levels that you should be looking on the Euro US dollar. Now let's have a look. Well, that's my MT5. Let's have a look at the US dollar Japanese yen this to end this video. And quite interesting, the US dollar Japanese yen, actually. We're going to start by looking at the daily on the US dollar Japanese yen. The daily just looks awful, right? Horrible, horrible chart. But if you notice, we are trading inside of a structure, right? This is a horrible structure on the daily, but a structure nevertheless. And we are actually, we rejected the bottom of the structure on yesterday and the day before on a dip on the Japanese yen futures. Um, Yesterday, the Japanese yen futures dipped about 1%, right? Which is a big move for yen futures. But we remain bullish that the Japanese yen, whilst the US dollar continues to dip. Our long play on the Japanese yen will never be on the US dollar Japanese yen, but because we are facing non-farm payrolls, we are going to look at it, right? We are still very much in a bearish market on the US dollar Japanese below this line. I'm going to change the color to white on the oscillator. I'm talking on the oscillator, right? We are very much bearish on this below this line, and on the daily we are still inside of this wedge, right? Looking at the hourly pay, at the hourly there's quite the interesting play here, or the interesting level in play here. This is the level that we are talking about, which is these previous highs right here. These previous highs right here are being retested around the 104 level, which is also a round number, psychological resistance. And we have no, we don't have a divergence. I'm sorry. Which I mean, I, I don't trade divergences. I use divergence as an extra confirmation of a trade idea, right, or of a setup. But we are retesting this level, the 104, on the hourly. Again, if we get some volatile news or very bad news or very bad unemployment numbers, we could see big players move the market to the 104.50 before moving to the downside. So remember that if we get red numbers and the market starts to rally, that is just a stop hunt, and you should be looking to sell higher, right? The US dollar. So basically, these are the levels that I'm going to be playing on during non-farm payrolls. If you want to get my trade ideas, the link is below this video. You should, it's quite inexpensive for an entire 30 days worth of this, right? So thank you for joining me, and I hope I'll see you on the inside.